Hey Bowtie Nation, Joseph Hogue here, and you know we love index fund investing here on the channel. I use it as a critical part of my portfolio for that stress-free market return, that sleep-at-night strategy. But there is a big problem in index fund portfolios out there. In fact, there are 5 problems out there, and to be honest, your strategy stinks. Stinks like fermented eggs wrapped in a diaper outside in June. I mean, you know I love you, but it is just horrible. So as a public service announcement, I'm going to reveal the 5 mistakes investors make with index fund investing, how they happen, and how to fix each, so you can get back to the things that matter most instead of worrying about your money. And one of the biggest problems is the overlap in index funds. Now for this, let me show you the top 10 stocks in each of the 3 most popular index funds: the Vanguard Total Stock Market ETF, ticker VTI, the Vanguard S&P 500 Index, the VOO, and the Vanguard Total World Stock Index, the VT. With these funds, you might think you're getting everything you need, spreading your risk across the entire universe of stocks. But let's look at the top 10 in each and see if you notice something. Starting off, here's the Vanguard 500 Index. Naturally, it's going to focus on those 500 largest companies in the US, so we see those big concentrations in Apple, Microsoft, and Amazon. Now, here's the Vanguard Total Stock Market, the VTI, and we get Apple, Microsoft, and Amazon. Okay, it's a total market fund, so maybe skewed to those US companies. But what about the Vanguard Total World Fund, the ticker VT? That's the entire world, right? And Apple, Microsoft, and Amazon. Nation, you are getting the same thing, so it makes no sense to hold all 3 stock funds. In fact, if you take a look at this 5-year chart, you will notice that the VOO, the Vanguard 500 Index, outperformed slightly, but more importantly, look at how the 3 funds follow each other almost perfectly up and down. Now, that moving up and down together really defeats the whole purpose of investing in different index funds. You're trying to invest in a few funds that don't move exactly up and down with each other, so they kind of smooth each other out, taking the roller coaster ride out of the stock market for your portfolio. And the solution to this one is just to know what's in your index funds and compare their price charts with others in your portfolio. Now, you can go to the homepage for any ETF or index fund and look for holdings or portfolio in the menu. That's going to show you exactly what is in the fund, including the weights of each stock. Now, it's okay to have some overlap, have some of the same stocks in different funds you own, but those top 10 holdings shouldn't look like a mirror image. Now, comparing the price charts is easy as well with any investing platform. Just click comparison and put the ticker symbols for each fund. Again, some similarity in those ups and downs is going to happen, especially in stock funds, as the market really takes all stocks higher or lower. You just don't want to see all your funds moving so closely that it's basically the same investment. We're just getting started, but with the interest rates on treasuries and I-bonds falling lately, I had to look somewhere else for those higher yields on my cash, and I found it with the 7% yield on Worthy Bonds, a fixed income platform with bonds backed by small business and short-term real estate loans. You can invest as little as $10 a bond and earn interest on a daily basis. Best of all, you can withdraw all or some of your money anytime with no fees or penalties. Worthy even has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. It's a great way to get that bond portion of your portfolio, the safety of bonds, but with a higher yield. One of my favorite features, you can even gift bonds to others with just their email address. I'll leave a link below to more information. Use the link and you're going to get an exclusive deal I worked out for everyone out there in the Bowtie Nation. Buy 5 bonds and get 1 free. Invest just $50 and get $10 free. That is a 20% return on top of that 7% interest rate. So look for the link below or just scan the QR code here. Now, another problem most index investors make is not harvesting losses for taxes. This is a huge missed opportunity that can save you thousands of dollars a year. You see, you're going to pay taxes on any investment returns each year. For pure index investors that never sell, it's not a problem because you're not booking any real capital gains, but how many of us are never selling our stocks or index funds? Even holding most of my investments long-term, I still booked almost $20,000 in long-term and $250,000 in short-term capital gains last year. Capital gains on which I paid a lot of taxes. But there is a way to strategically invest, using losses on some of your funds to offset your gains and save thousands in taxes. This is by watching your funds and using times when they dip to temporarily sell so you book some of that loss. As an example, we see 3 index funds here: the Vanguard 500, that VOO, the Vanguard Total Bond Market, the BND, and the Real Estate Sector SPDR, the ticker XLRE, through last year. And you can see that in October and November period, you could have taken a loss on the BND or at the XLRE to offset the gains in the VOO. Now understand, selling a stock or a fund to book that loss and offset some of your taxes means you can't buy it back for at least 30 days. So this is a tricky strategy. What I do to solve this is to find another fund that is similar and very closely tracks the returns on it. For example, if I sold my Vanguard bond fund, that BND, in October to book some of those losses, but I didn't want to miss out on the potential rebound, I could put that money in the Vanguard Intermediate Bond Fund, the BIV, and you see here the two bond funds track each other almost perfectly, so I wouldn't miss out on that upside bounce. Next on our list of index fund mistakes, and a big one here, only investing in stock indexes. Now I know, we talk about stocks here on the channel, and that's where the returns are. There is nothing fun talking about bonds, unless it's a different kind of bond. Even real estate has been disappointing over the last few years. But not only do those bond and real estate funds give you the opportunity to harvest losses if they dip, investing in all three asset classes takes the stress out of your portfolio. This is a chart of the daily percentage changes in the stock, bond, and real estate indexes separately over the last year. That stock index, the S&P 500, is the most volatile here, crashing 3% in a single day on 3 occasions, and typically losing more than 2% of your money. Now that might not be a problem for those he-men of courage out there, eating lightning and crapping thunder, but us mortals see thousands wiped off our portfolios with that 3.65% loss in a single day last year, and we get scarred. That can lead to all kinds of bad investment decisions like panic selling and withdrawing your investments. But now look at what happens to those ups and downs when you combine these 3 index funds with 65% of your money in stocks, 15% of it in bonds, and then 20% in real estate. You see less than 2% daily changes, and most of these are under 1% one way or the other. That is the kind of smooth ride you can sleep through. And for that sleep at night strategy, you give up less than 1.5% difference in returns. That diversified stock, bond, and real estate portfolio would have returned a healthy 19.5% over the last year, just under the 20.9% return on the all-stock portfolio. And then for those years when stocks crash and that bond index fund saves your butt, well, you're going to be naming your firstborn after me. So the solution here, you're still going to want most of your money in that stock fund, as much as 60 or 70%, but do not neglect these other assets like a bond fund and real estate assets. Related to that diversification problem is index investors not rebalancing back to their target percentages. That's because even if you have a bond portion of your portfolio through years of a bull market and outperformance by stocks, that stock part of your portfolio is going to grow larger. Let's say you started with 80% of your money in stocks around 2003, with the rest diversified in a bond index like the iShares AGG. After 4 years of a bull run, that outperformance in stocks would mean you have upwards of 90% of your money in stocks and then just 10% of the safety of bonds. The problem becomes if you neglected to rebalance, taking profits in your stock fund to buy more into the bond fund, you would have seen half of your portfolio wiped out in the next 18 months. Now, there are no hard, fast rules for when to rebalance your index funds back to those percentages you want. You can do it every couple of years or when the percentages have drifted 3% or more. Either way, it's going to help you keep on that path to reaching your goals, even through a stock market crash. And the biggest mistake investors make with their index funds is assuming that all funds are diversified. Remember, the whole point of buying an index fund is to be the market, to get those broad market returns without all the risk in individual stocks. But folks, something has happened to the stock market over the last year that has flipped most index funds on their head. Because of the giant return on big tech stocks last year, any stock index based on the market cap or S&P 500 index is now dangerously overweight just 7 companies. The top 7 stocks in the S&P 500, those magnificent 7 big tech companies, including Apple, Microsoft, and Amazon, now make up over 28% of the index. That is unprecedented, with the share of the top 7 normally closer to about 15% of the index. You see in this chart, even in prior bull markets, the biggest 7 stocks were barely more than 20% of the market. And it's not just the US index or those based on the S&P 500, but even the world indexes like the Vanguard VT and the VTI. Those biggest 7 companies make up more of the index than all the stocks in the UK, China, France, and Japan combined. And I know, it may seem like a giant nothing burger, but there are some very real risks here for index investors. First is that you're not spreading your risk out like you thought. Nearly a third of your money is in these index funds is tied up in those 7 tech stocks, meaning it's not so much a diversified index fund, but just a bet on Apple, Amazon, Microsoft, and these others. And that's great if these 7 heavyweights can keep going up, but is that really where the best returns are going to be? After that bull run, these 7 stocks are trading for a price more than 33 times their earnings, more than 55% more expensive than the average PE ratio for the rest of the stocks in the market. Those magnificent 7 tech companies are some solid companies, but if I'm buying index funds, it's not because I want a concentrated bet in a handful of stocks. I want that broader market return across a market of stocks. The solution here is to look for a stock fund with equal weight companies or that invests in different indexes. The Invesco S&P 500 Equal Weight ETF, ticker RSP, holds equal amounts in all 500 S&P 500 stocks instead of holding more of the larger companies. That means you get that broad market exposure to all the largest companies in the United States without that concentration on just a few trillion-dollar giants. Another option here might be something like the Vanguard Small Cap ETF, ticker VB, which holds shares of over 1,400 smaller companies, a different index than that S&P 500. These are still fairly large companies at an average market cap of over $6 billion, but outside the big tech names you see in the major index. Get the power of bonds with a higher yield on the Worthy platform. Look for the link below for an exclusive coupon for the Bowtie Nation. Buy 5 bonds and get the 6th bond free, plus that 7% yield. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.